Fantastic. Thank you so much for coming today at such an early moment in the day, on the second day of the crypto convention. It's a real honor to have you all here. Very excited. My name is Chris Berg. I'm a professor at the RMIT Blockchain Innovation Hub. We're the world's oldest social science research center into blockchain technology. So when I say social science, I mean I'm an economist. I work with a lot of other economists, lawyers, political scientists, sociologists. You heard yesterday from my colleague Lizzie Morden, who's an accounting scholar, to understand what blockchain does for the world, not just how it works, but how it can be integrated into the economy, what it means for public policy, what it means for business, what it means for us as citizens and consumers, and so forth. And I'm going to try to share today what our research has found. At the very high level, what we think is going to happen in crypto and what crypto is going to do for the next 10 years. But I'm going to start with this. Some of you, I'm a Melburnian, so this is a very important thing for me. This is the building that was that opened in 2003. It was the Age's print shop. It was commissioned in 1998, around 1998, 1999. It cost $220 million. And it was a major change to the Age, where they were going to send all their printing out to Tullamarine. So every time you drive from the city to the airport, you go past this building. Now, it was commissioned in 1998. This is what the Age's website looked like in 1998. It was pretty basic. It was, interesting. They obviously knew that they needed a website. They knew that that sort of stuff was happening. But between 1998 and 2014, I'll talk about 2014 in a moment, the internet came for newspapers. What happened in between that time, as they built this building until they eventually sold it in 2014, the entire market for print collapsed. This is the share of Australian advertising expenditure on print media versus online. Online sort of blows up, starts moving up the moment they open that print shop. Print media advertising declines dramatically from around that time as well. The moment they open that print shop, everything falls apart. And now that beautiful new building has been sold and is now an automotive sale. You can look at, it's really sad because that little tower, that's the shape of a newspaper. This is a monument to the folly of poor decision making in a digitizing economy. The argument I'm going to make now is that the internet came for print. The internet is now finally coming for the finance industry because of the things that we are doing here at this convention, in the crypto economy, in blockchain, Web3, and so forth. All right, how am I going to spell that out? At the most high level, I think we are discovering now that every single asset, certainly every single financial asset, is ultimately a digital asset. We can take everything. We can take money, we can take equity, we can take bond, we can take fixed income products, we can take everything that we have in the financial sector, and ultimately we can tokenize it. We can turn it into a digital asset, not just an asset that happens to be online or happens to be stored in servers, but a tokenized asset. But fundamentally, what are we doing when we tokenize an asset? Really, all a tokenized asset is just a list of rules on a chain, and that's a smart contract. So all of those assets, they're not just tokens, they're actually we've decided that each asset is an individual set of rules that can be encoded, that can be placed on a chain. But I think we can go even further than that. Not only is each digital asset a smart contract, but every smart contract, it's just binary logic. It's all just computational logic that we can put on chain, represented in the most basic form, the simplest form of information we have. So ultimately, we're taking our financial system, the complexities of that financial system, and we're turning it into computable binary logic. That's what happened to the Age. What we managed to take binary logic and we figured out, well, we can actually do news with that. We can replace all that complexity with just binary logic. It can be reduced down to that basic concept. But it didn't come really for finance at the same time. because we were missing a really substantial piece. We knew that we can make digital assets, but we didn't know how to make them trustworthy. We didn't know how to make them tradable. We didn't know how to make them exchangeable. Now we can. This is what we're doing by turning everything into a financial asset. But why does that matter? You'll notice that I've spoken about, I'm bringing it right back to binary logic, which is a weird way to talk about crypto. It's because those zeros and ones are the base level of information that we need. And any other 0 and 1, any other base level information can interact with any other base level information. And that gives us this amazing concept or this amazing characteristic that we call composability. It's the idea that everything can be built on everything else. Everything can be exchanged with everything else. Everything can be communicated with everything else. From that base level of logic, we can build out smart contracts. With those smart contracts, we can knit them together, we can turn them into tokens, we can turn them into protocols, we can turn them into APIs, we can turn them into an entire DeFi ecosystem in a way that we've never been able to do so before. Realized I put my timer over here. Why don't I keep it much closer to me? Because they're gonna walk up and pull me off the stage, they were saying, which I don't want to happen. So composability is really what we've managed to build by decomposing these assets into their basic logic, into their basic contracts and tokens. So composability, it's great. We're all used to composability. We all love ERC20 tokens, so forth. But why does that matter? Now, assets have always been composable, but they've always been composable at a price. If you hold a lot of shares, if you hold a lot of equity, if you hold a lot of debt obligations, you could always go to a bank or you could go to a large financial institution and they could wrap that up for you. They can write contracts that say, here, we'll lend you money against that. If anybody's seen the WeWork TV series, you saw how he was able to take a $50 million loan off the back of his equity that wasn't liquid. He had to do that though by going to the top of the bank. And he had to do that by paying quite a lot for the privilege. They had to write these contracts, legal contracts, they had to do with it. So we've always been able to have composable assets, but we've had to pay a lot of lawyers to do it for us. Composability, though, gives us innovation. Now, I'm an economist, and I want to tell you that the most important way that we get innovation is by matching ideas together. I've got two colleagues, Jason Potts and Darcy Allen, at the RMIT Blockchain Innovation Hub, who have been studying exactly how entrepreneurship works. Where do the ideas for new businesses come from? And their argument is that ideas for new businesses, ideas for new innovations, come from when two entrepreneurs meet each other. Hopefully they've got different backgrounds, they've got different ideas, and they can iterate ideas with each other. That composability is giving us more things to do. And we've radically increased the composability of the financial system. We get out of that more innovation. Why does more innovation matter? More innovation matters because fundamentally, there is no other way to get prosperous, to get economic growth, to build a rich and dynamic economy without innovation. That is the one thing that makes us rich. That is the one thing that will make our children rich. We need more innovation. We get more innovation from composability. We get more composability from the digital financial assets that we are now building. So we're building right here what we call a truly digital economy. Not an economy that has digital, we live in that. We're building an economy that's fundamentally different, digital. We started with the feudal economies, we had an industrial economy, we live in a post-industrial economy, we are moving into this truly digital economy. Now I want to say that a new economy needs new economics. I don't think that the economic profession, my profession, has actually been able to deal with the post-industrial economy very well. In all seriousness, there are a lot of really difficult results in economics just about platform businesses, just about how do we understand how Uber works, matching riders and drivers together. The ACCC is trying to figure this out right now because they would like to regulate platform businesses as well, but the economic knowledge isn't even there for the Web 2 economy, let alone the Web 3 economy. I'll tell you why. This is the mainstream view of digital economics. This is a paper published in the Journal of Economic Literature. It is really one of the top journals in economics. You have to be invited to write for it. It's what the profession sort of summarizes the state of play itself. And they say the digital technology reduces economic costs around search, so how do I identify who I want to trade with, replication, how can I copy information, transportation costs, tracking costs, and verification costs. But I don't think that really captures it, and it certainly doesn't capture the Web3 economy that we're building today. By contrast, we have what I call the RMIT view. Our argument, well, I hope that you could all call it the RMIT view as well. That'd be really, I'm looking for adoption here. Our argument is that blockchain, Web3, cryptocurrency is an institutional technology. It doesn't just help us do things faster or cheaper. It's a technology by which we coordinate ourselves. We do it differently. We restructure the way we interact, not just what we're interacting with, not just building faster widgets or more productive factories. And it is exceptionally rare to invent a new institutional technology. The other institutional technologies you'll be very familiar with. The company is an institutional technology, an institutional set on which we organize ourselves. Governments are institutional technologies. Markets are institutional technologies. We don't invent these very often, but we have invented them, or we have just invented one in 2009, and we've got an extraordinary, innovative opportunity as a result. Blockchain ultimately provides the bottom layer infrastructure for everything that we are building for the future of the economy. Previously, we would have used things like corporations or governments to build on top of, but now we have crypto, Web3, and blockchain, on top of which we build big data and oracles, artificial intelligence, identity, the Internet of Things, DeFi, NFTs, DAOs, GameFi, you name it, we will build on top of this new institutional layer, this foundational institutional technology. So, I want to give you one example of why this is such a radical change. We're in the crypto space. I've been in the crypto space for some time now, and we've all spent a lot of time thinking about the nature of money. We all started with Bitcoin, and we started thinking about, well, what does it mean to have a new private money? That's what got me excited about this too. But I actually think that frame that we've been considering cryptocurrency through is actually wrong, because I don't think we need money at all anymore. Let me briefly tell you about the history of money, or at least one of the most dominant theories about where money came from. Now, money came from a really basic problem, that barter, before we had money, we had a barter economy, and bartering is difficult. It's hard to find someone, if you're in a barter economy, who you can trade and exchange with, who you can match. What if I want to trade a horse for a cow, but the person who's got the cow doesn't want the horse, so maybe we have to trade through the person who has a pig, and so on and so forth. So money sits in that nexus, and money fixes the problem of barter for us. Where instead of trading horses and cows, when I want a horse, I'll buy one with money, and if someone wants to get rid of their cow, they'll sell it for money. We got money in the center. Money is, in this story, an institutional technology. It's something that we use to coordinate ourselves. It's a technology that we're all very familiar with that makes a lot of sense. I don't think it makes as much sense anymore now. Because fundamentally, as I've said, we've started to tokenize every financial asset. Every asset that can be tokenized, will be tokenized, is being tokenized. And we can trade that trustlessly, at high velocity, and using the rest of the technology stack, particularly things like artificial intelligence, to trade between those different assets without ever needing to go through money, without ever needing that money in the intermediary. We've called this, colleagues and I have called this hyper barter. It's like barter, but it's a hell of a lot faster. It's barter, but it's enabled by blockchain. It's enabled by artificial intelligence. It's enabled by this new institutional technology that we're working with. So what does the next 10 years look like? I think we've already seen here in this room this weekend exactly how these institutional layers are being built out. We've seen the massive, radical increase in tokenization of traditional assets. So we've got not just cryptocurrencies and new financial assets, we've got them composable with every other financial asset that we have imagined and can imagine. We can bring real world assets. We're using real world assets in DeFi protocols already. MakerDAO's DAI stablecoin is collateralized by real world assets. We've got institutional players in this room who are building out that technology. The question I have and the question that I think a lot about is how can we get all these parts together? How can we take the assets that they're building on private blockchains, on public blockchains, how can we make them tradable with each other? The institutions for that are being built. That's what the next 10 years looks like. That is a radical change that we are making in this room and in our community. So thank you very much. I've got 10 minutes. I'd be very happy to take questions. I don't know if we've got anything else, but. Have we got someone who could carry around a mic? Does anybody get any questions?
Giving controllership of our own money is going to be a very different concept for them, especially when it comes to financial or fund management individuals, as you would know. So I guess it's how would you bridge that gap in terms of, because it's taking control out of them and ownership, which they're not going to like.
Yeah. So look, this is already being done. So there are a lot of institutional players that are starting to do that. The question becomes, how do we make it, as I see it, it's not so much do the institutions want it to occur, because the institutions actually do because they want to use smart contract enabled platforms. They would like to use smart contract enabled platforms on private environments for two reasons, one of which is that control, but the main reason is regulatory hurdles. We haven't got good guidance about what AML KYC would look like. We know that we're going to need to AML or KYC customers at some point in the stack. The question, the very live regulatory question right now is, what happens once we start wrapping those assets, bridging them onto other chains, moving them through different protocols that may or may not be permissioned or KYC protocols? Will we have to do KYC at every moment? Now, we don't have good guidance on that. We don't have any reason. No regulator has offered us any route around that. But the thing that I'm very excited by, and I think that we as a community should be focusing on more, is sort of RegTech solutions to that. There are some people in the Australian community, Jack Deeb, Joni Pirovich, and a couple of others have written about zero knowledge KYC approaches that might allow us to do KYC while revealing nothing about, nothing other than we've been KYC'd. So that's an interesting opportunity. Know your customer rule, yeah. So there's a bunch of options there as well. But it's mainly a regulatory hurdle as I see it.
So are you thinking that it'll become more of will link to a global regulatory system, because with blockchain it's borderless in essence. So it's going to have to become, do you think we're going towards a more global regulatory system as well through this?
Look, that's a really good question. When we have a global regulatory system in a lot of ways, around things like capital standards and so forth. I don't think that we're going to see a global regulatory system. I think we're going to see sort of national regulatory environments that cover things like particular private chains, but you can move off those private chains into other things. But it's going to be very messy in the same way that it was incredibly messy for the Age when they had to sell their print shop then. We've got a mic wandering around.
So one of my favourite lines is from John F. Kennedy. He said that it'd be great if poets understood politics more and politicians understood poetry more. I always think with some of these discussions, it'd be nice if the tech guys and the economists understood law more, and it'd be nice if the lawyers understood the tech more. Because I think one of the fundamental issues which will be solved, which will need to be solved in the next 10 years, is, and I welcome your comment on this, it's just around, it's all very well to transfer kind of digital assets or traditional, traditional Bitcoin online and in its own closed system. But then people assume that you can just as readily transfer title to real world assets by simply transferring that bit and byte online, and that's simply not the case. That's when local law jurisdictions and all the stuff you learn in law school about properly perfecting security and assets and prioritization and everything else all kicks in. So where do you think that's heading, and what mechanisms are available or are being developed to solve those type of problems in your view?
Yeah, so there's two ways through that. So you can have a trusted authority, you can have a custody provider, and we'll need trusted authorities in most environments for any real world asset, certainly any terrestrial asset that's fundamentally non-digital. So we do need those sorts of trusted service providers, and we've got them, and people are building those out. The second alternative is that there are actually some really interesting protocols being developed that provide sort of dispute resolution services in a decentralized way, that we can see a path towards building actually truly decentralized models of real world asset custody and those sorts of things. That I think that's an active area of research and entrepreneurship, and that's certainly not live now, but there are two paths there, and I think we're going to have both is the answer. Just at the back. Oh.
Hi, thanks. My question is, so taxes is a form of revenue, right? And say we want to build a new road, so we use some of that taxes, right? But what's your take on if we can tokenize everything? Will governments at some point realize, well, instead of having and collecting these taxes, we could tokenize, the road, and then we can all contribute to it and trade it, and then the road gets built. The same way now some real estate are thinking to pool funds for developers through tokenizing that. Well, maybe not in the next 10 years, but maybe in the next 2 or 3 decades. But do you think that is something that we could be moving towards? Thank you.
Yeah, look, so the answer is mostly yes. So I don't foresee that there's going to be substantial change in what national governments do. But I do see that there are more and more private communities that will create their own systems of funding their own public goods. So particularly in the United States, there are small private communities that need to do internal infrastructure provision, and these sorts of asset classes are actually really well designed for that, because you can delineate ownership in a way, and you can take advantage of smart contract infrastructure to manage that ownership in a way that is very difficult to do so now. There are also a lot of really interesting experiments in charter cities, in private communities, special economic zones, that I know are interested in using some of these crypto rails and blockchain infrastructure to manage themselves. So I think there's opportunities for that. But the government will continue to be the government, which has pros and cons. I got probably time for one more question, don't I?
I just wanted to say I agree with the other gentleman about tokenizing physical assets. I think it's going to be very difficult because of enforcement. It's very separate. I think tokenization is a bit more, definitely more for financial stuff, but real world assets is still to be seen. So yeah, that's a very valid point and very good point. My question was about the hyper barter that you were talking about before, where you said that you don't need money, but I just don't see how you can trade without some sort of unit of account. So how would you say in your previous comments about hyperbarter, about not using money, like what would that look like? What do you think?
Well, so it depends what so we can all have our own individual units of account, in a lot of ways. But the question becomes, so a lot of people here may denominate in ETH already, or US dollars, or so forth. But the trade itself can be worked out against a matrix of different prices, relative prices, in the same way that you would do foreign exchange in, right? So, you know, Forex traders make these sorts of calculations all the time. What is the relative price against a matrix of prices rather than against one particular unit price? And that's what the technology is enabling us to do. It may still mean that I'm going to denominate my personal wealth in some unit of account. And that might well be Australian dollars or US dollars or what have you. But the function of money there is very different. It's not the same as what we're used to trading through that money. We're just denominating in a money, if that makes sense. But it is 10:10. I'm happy to talk about it afterwards. It is 10:10, so thank you so much for coming, and I hope you all have a fantastic rest of the day.